Let's talk to Mike Ingram. He's the Chief Market Strategist for WH Ireland. Morning to you, young Mike.
Morning, Moose.
Right, lots of things we could talk about on your soapbox.
Yes.
Let's go with some favourites. Okay, let's go with some old themes. Let's kick off with Mr. Carney.
Gotta love him, haven't you? Well, as we discussed a second ago offline, I think the only forward guidance was my forward guidance on his forward guidance. That's
Right.
the only thing you should have. So I seem to recall on another TV show, sorry Moose, there are others, saying if you want to know about where interest rates in the UK are going, you might as well listen to the man shouting at pigeons in Hyde Park Corner.
Right.
And I think over the last few years, I've generally speaking proven myself to be fairly accurate. So just to roll back, if we go to the November MPC meeting, at that time, they were relatively relaxed about inflation. They did need to tighten up a bit on market expectations where they were at the time. But the overall shape was that we're going to see 2 quarter-point rate hikes over 3 years. By February, that had changed to 3 quarter-point rate hikes over 2 years, which is effectively doubling the pace of tightening, albeit from a low base. And then over the course of March and into April, we've had a series of relatively weak economic data.
Yep.
You know, weak industrial production, weak manufacturing, weak retail sales, relatively weak wage inflation, and we've capped this all off with a 0.1 flash estimate of GDP for the UK in the first quarter. So, you know, Mark Carney felt the need to row back on some of the more hawkish rhetoric that we've seen. Within the last month, we've seen the implied probability of a May 10th rate hike of 100%. For most of this month, April, we've been hovering sort of 85%. Last week it went down to 65%, and then of course when we had that big growth shock, because the market was expecting 0.3 for that GDP, 0.1, 25%, and now the market isn't even sure about seeing a rate hike at any point in 2018. So it's all over the place. I would say sterling actually, considering has been quite settled. But yeah, I mean, it just, frankly, it makes a nonsense of economic forecasting, to be honest with you. And, you know, for me, it vindicates, you know, my own cautious stance on the UK economy, the domestic economy, because it's still looking pretty fragile. We'll see manufacturing PMIs tomorrow, so that'll be another clue.
Okay, so it's Merger Monday again.
Yes.
Jay Sainsburys up 16% this morning. More to come?
I'd be surprised if the CMA waived this through, the Competition Markets Authority. I mean, if you look at the combined entity, they would control something like 32% of the grocery market, Tesco 28%, top two, 60%. Really? I mean, there's always the argument that, you know, Asda's stronger in the north, Sainsbury's stronger in the south. But you know what? I mean, I don't see how this is, you know, I don't see how it can survive in its present form. I mean, the last time we saw a big merger was Morrison's acquisition of Safeway, and of course at the time Asda wanted to buy that, and they said, well, you know, that it's too big. Now, okay, things have moved on in the last 14 years. I mean, they, you know, Sainsbury, Asda will argue, well, you've got a lot of competition now from the discounters, Aldi, Lidl. I think together they got something like 13-40% market share. You've got the, you know, internet retailing is very, you know, is thriving. I think it's about 18% of all retail is now done online. Obviously, the penetration on grocery a lot lower. But yeah, I think I'm finding it quite difficult to see how, you know, how this deal is going to survive intact. I'm not sure the people who point to the recent Tesco Booker deal can really say that's a precedent, because the CMA did take the view that these were very much separate businesses, where of course there's a very clear overlap between Asda and Tesco.
Okay, and finally to wrap up, state of the stock markets.
Yeah, not too bad actually. You know, we are all those sort of risk indicators, these implied volatilities, the skew in the options market seems to have settled down, not to the sort of comatose levels we saw in December, but you know, they are still tracking down. If you look at the results season, I mean, I suppose the US is where we're furthest along, just over the halfway mark. At the moment, it's about a 7% beat on earnings. And if you look at the tech sector, it's beating by 10%. Okay, multiples are challenging, but it does seem that, you know, the top line is bringing in the goods. The only thing that I would say is that if you look at some of the growth indicators, there's a bit of a split. Because if you look at the economic forecasts, and obviously we mentioned at the start of the show the perils of economic forecasting, you've seen the economic forecasts pretty much everywhere hold up very well, even during this period of market turmoil. If you look at some of the, what are generally regarded as some of the more forward-looking indicators, some of the PMIs, they've looked quite soft, particularly in Europe. European Central Bank, the ECB, sounded quite relaxed about European growth last week, but there are some doubts out there. And one of the big longs in terms of equity investing has been Europe, and we've definitely been seeing people lightening up there.
On that note, young Mike, good to see you. Talk to you in a fortnight.
Pleasure's
That's
always.
Mike Ingram from WH Island.